Hi, I'm John Lowell with October 3, and with me today is my partner, Brian Donahue. Welcome to the pension finance update, where we recap the month of January 2024. So, the way I look at it, January was not one of those really exciting months. Assets and liabilities moved somewhat in tandem, and we saw some improvements. Brian, is that a fair description?
Yeah, I think that's right, John. The month for stocks returns were mixed, a little bit up, a little bit down. On the other hand, interest rates moved a little bit higher, so that's going to push liabilities down. So really, what we've seen is another 1 month of incremental improvement, and that's been a theme that we've been entertaining for a few years now. These tailwinds that pension sponsors have been enjoying. The short version is stocks outperforming bonds, and that adds up to improved pension finance, the best funded plans we've seen this century in the U.S. private pension system. So the system's healthy, and for a lot of employers, this is really good news. I think if you really want to manage your pension plan properly, this is the position you want to be in. You want to maintain a fully funded plan. It allows you to play offense and not get run over by overhead costs and compliance issues that afflict underfunded plans. So I think a lot of employers, as they look at the good news, you'll see there, as we've mentioned, frozen plans in a position to terminate. Maybe hundreds of plans have been frozen for a long time that uh, have enjoyed these tailwinds. There's other items that we know sponsors are looking at in 2024. Lump sums, lump sum windows are in the air again in a conversation. The pattern of interest rates in late 2023 compared to where they are now means this can often be a good move from employer balance sheet perspective. So we think a lot of these employers are going to be looking at that sort of thing. We also know with the swings in interest rates we've seen the last couple of years, PBGC premium management has become tricky if you're not paying attention. We've seen in 2023 dozens of plans that ended up paying a lot more in premiums than they needed to. We think there are opportunities for 2024, but again, these well-funded plans generally are able to manage those decisions and play offense. So while we've spent a lot of time talking about all the good news, it's worth understanding that there's a sizable chunk of plans, maybe 20% or so, that really haven't participated in the improvement that we've seen the last several years. Typically, these are plans that are not well funded, and that often is associated with organizations that are struggling with cash. So not surprising that you see that show up in pension underfunding. Well, for these plans, they have overhead cost burdens, particularly PBGC premiums, that well-funded plans don't face, and that's a real obstacle for improving funded status. Also, just the nature of being underfunded. If you're investing $75 against $100 of liability, your assets have to work that much harder just to stay even. So we do see, there's a sizable percentage of plans that really haven't participated so much in this big improvement that we've talked about the last several years. Um, and the other thing that we think is highly relevant for that group is that with the increase in interest rates that we've seen since 2022, really how that translates for these plans is that the funding relief that has been in place and they've enjoyed for the last several years is basically going to not be applicable for 2023 and 2024 at least, and unless interest rates move back lower for the future as well. So a lot of those underfunded plans, they've in a sense benefited from funding relief in that they didn't have to put the money into their plans, but the terms of that or the repayment of that underfunding have changed, and those plans are likely looking at larger funding requirements than they would have guessed a couple of years ago. And so while We know, the majority of plans are in good shape and able to play offense. We see definitely challenges for this segment of the market. Um, all the ERISA compliance stuff, all the funding due dates, the stuff that's been easy to satisfy while funding relief was in effect. Those are going to be tougher to navigate now, and decisions that employers are making as early as April 15th are going to make mean the difference between maybe successfully navigating the road ahead and less successfully doing so.
So to put what you just said into terms the way I think about it, we've really got a dichotomy for 2024. We've got those plans that are not so well funded, those plans who have been minimum funders under funding relief, that on a what you might think of as a real basis, a true actuarial financial basis, are not that well funded right now. They've got challenges. They may have some really significant challenges for 2024. And the way they look at things strategically may make a big difference in how things play out for them going forward. At the same time, there are the plans that have funded essentially as if funding relief never came into being. So they've stayed well funded. And those plans, whether they're ongoing or frozen, and if they're frozen, whether they are looking at things they might do or looking to terminate, all of them have opportunities that they may not have had in years coming into 2024. Does that all jibe with you?
Yeah, I think you've described it perfectly, John. I, I would just add, as a consultant, these many decades. If I were a pension sponsor and I had the wherewithal to be able to play offense to get out ahead of these things, like the majority of plans do, you really make life a lot easier on yourself in terms of navigating these rules. Underfunded plans are going to need a lot of consulting help, um, and sometimes these are the plans that are smaller plans, especially, maybe aren't going to be have access to the kind of help they need. But it's going to be it's not just April 15th. Like, you need to understand what's coming up over the next 4 years. Uh, to know that now, right, allows you to plan instead of just getting blindsided and ping ponging around from putting out one fire to the next.
So if I'm one of these underfunded plans that really has either not been able to or just chosen not to take advantage of the favorable conditions we've had for pensions the last few years, and I'm in one of those positions because funding relief is now, while it's still technically in place, it's effectively gone because the funding relief interest rates and the real interest rates have converged on each other. So because of that, if I'm one of these underfunded plans, I'm really fighting an uphill battle the way I see it. It's kind of like that person who's incurred significant credit card debt and is struggling to both service the debt and to make their monthly payments. So you've got that combination of the two. So for pension plans, is it a fair statement to say that companies that have been going along funding small amounts for the 2024 plan year may see some really significant contributions of the level they've just not budgeted for if they've not really been fully paying attention to what's going on?
Yes, that's right. And the funding rules, they do have amortization periods and stuff. So uh, hopefully, in most cases, those are going to be manageable. But another example would be trying to keep your plan 80% funded. This is really important for a lot of plans, particularly plans that pay lump sums. And the withdrawal of funding relief for now is really likely to produce like contribution spikes for employers that are trying to get over, hit a certain funding status. So these are the rules. We had these rules in 2008 and 2012, and with relief, they've been pretty easy to comply with for the most part since 2012. But it's a tricky set of rules, PPA, right? And those rules are back and with a vengeance now.
So, leaving for a second those plans that have the challenges, when we think about opportunities, I think we'd be remiss if we didn't say that there is the opportunity for some frozen plans to kind of follow IBM's lead and do what they did and use some of that surplus that they have in ways that are very cash effective to provide pension benefits that they've not provided for a while to their employees. You also brought up earlier the whole idea that 2024, for somebody who's really committed to terminating their plan, might be the year. This is the year to pull the trigger, perhaps. For those companies, what caveats might you offer them? What should they make sure that they do so that if they are committed to terminating this year, they can get it done without an infusion of cash?
Yeah, again, lump sum settlements ought to be helpful to financing things like planned termination in 2024, just because of the way the rates shook out. If you want to terminate your plan, one of the real hangups is sometimes data. Particularly, I think about deferred vested participants. So these are people that are owed a benefit. They're not receiving a benefit today, but they will in the future, but they no longer work at the company. And that can be a real hang up, making sure that you've got your data scrubbed and in order. uh, Also, if your plan is fully funded, you probably want to make sure that you're more or less immunized. There's no sense in rolling the dice. If you've already got enough assets to terminate and you want to move ahead and terminate. So yeah, there's definitely things employers want to do. I We saw how in the end of 2023, a lot of insurance companies' books filled up, and companies that wanted to buy annuities in the fourth quarter of 23 got shut out. So the plan termination process, in the best of circumstances, is a months long process, maybe more than a year, depending on how you want to do it. But that's all to say, if you want to get that done this year, you probably don't want to wait too long to get the ball rolling.
Well, Brian, this is really good stuff. But again, just to summarize and wrap up, 2024, if you're a well-funded plan, you've probably got a lot of opportunities. If you're a poorly funded plan right now, you've probably got a lot of challenges. Either way, there are things to look forward to for 2024. And we'll be back next month to see how we've done 1 month forward and to let you know what to expect going forward from there. Thanks so much for joining us.
Thanks, John.